1 minute or
Okay, we are live, I believe. Oh, did the echo just get worse? I think I hear now.
no. We're doing better on the echo today than ever.
All
Do you
right,
think?
great.
I wonder if any of our viewers notice my plants growing back here.
Do you have plants behind you? I don't even see them.
Yeah, it's like one of those. They're like up here. It's like I guess the light's too bright, but it's like
Yeah.
yeah, like even a month ago. I mean, it's like it's not plants. It's like herb. It's like one of those like portable herb gardens. But
Hmm.
yeah,
All right. Well, nice little background story as we're waiting for a few people to get in here. We have some good topics today. George had a big shift that if you get the newsletter, you would have seen that come out yesterday. But we'll kind of run through it a little bit for people who may not be getting that. But George, if you want to talk about a little bit of your update on your stance in the market.
yeah. So I think we saw some interesting behavior towards the end of last week, especially as it relates to the SPY net option sentiment kind of going up more towards QQQ. Not as much as we saw it when I like made the bearish shift, but now that's something that we've seen. Basically, the big shift I made before, it wasn't as extreme. I mean, it closed the week. I think SPY net option sentiment got up close to 25, where QQQ was like maybe in the high 30s. So it was a bit of a different situation, but still, yeah, definitely more of a concerning bear trend when people kind of like stop speculating on the QQQ. Now, another thing that we saw in the newsletter, which I would recommend if you haven't read it, it's a really like important one. As I reviewed the past performance of metrics like profitability, growth, short pressure, and dark pool. So it's a really interesting newsletter, and we've definitely seen like profitability and especially profitability plus growth perform very well. So yeah, even with the QQQ going up, profitability this year has been a much more solid indicator than even I thought until I reviewed the metrics, which is why I'm saying, if it does look like non-tech or just extremely profitable companies for like, I would say for the foreseeable future are going to be the good ones to target, where we see that behavior that has meant bad things for especially the QQQ. When you see QQQ and SPY kind of diverge, they are diverging. I mean, converge. They are converging at kind of like a higher number than they did before, which is interesting, and it could mean something different. But nonetheless, I think it is just a bad sign if people are speculating just as much on kind of like non-tech as they are on tech.
Agreed. And I had a few things I wanted to ask you about in more detail because well, in the last month we've kind of changed, but before that it was always like Meta, Tesla, like big growth stocks, tech, AI, all that type of stuff. And I found a line in the newsletter that you were saying like if the SPY continues to show bullish signals, you'd be interested in non-tech value stocks. So do you want to explain that a little bit further?
Yeah, like EQIX is one that I targeted. It's a real estate stock, and one of the reasons I said is you don't typically see real estate stocks that high up in upside breakout and net option sentiment. Um, but yeah, just anything generally that you can look at the highs and lows and profitability, check out stocks that aren't, anything with high profitability should perform well, and that's what we basically saw in our research. But I would say especially like non-tech has more room to go up. If the market does, even if it's uneven and certain stocks perform and certain stocks perform less well, I think there's definitely more room for the value stocks there. I'd avoid anything that's in like consumer goods, even consumer defensive, something that we've seen don't typically see as something that in economic difficulties gets hit as hard, obviously right there in the name. But yeah, I would say that the really important thing to look for is just like businesses that are generating good cash flow that there's also really good options bets on, and that's just really easy to see. You want to control for high profitability, high upside breakout, high net option sentiment, and low downside breakout. And I would say that the nice thing about that in particular is that you could be a little less, especially as you're going non-tech where there's non-speculation. I would say if you're above 65 or 70 in profitability, upside breakout, and net option sentiment, that's a pretty good sign that's a good business to buy for the rest of the year into 2024. Even if there are economic difficulties, I think that that's why I'm guiding more towards that, because I can see them performing well, those kind of stocks performing well, regardless of economic scenario, or at least beating the market.
Indeed, and we've mentioned like the credit crunch that could come, so these companies should be a little bit safer in that kind of a scenario. And then the other thing I wanted to hit on with your newsletter is I thought it's a really interesting point that you put in there, but I didn't really understand it fully to the depth that I would like to. So I wanted to ask about, you mentioned like a divergence between the dark pool and the short pressure you're seeing and how that's significant in stocks. So can you explain that maybe? So people didn't understand
Yeah,
it, they may be able to.
it's so interesting, mostly because I always thought that dark pool was a little bit of a more muddled signal, and you do see it get muddled a little at the end. You basically see that it's very reliable, especially over 80, over 60 dark pool rating. Everything, we looked at 1 day, 1 week, 1 month, 3 months, and stocks go down with high dark pool rating on the whole. But we actually saw a bit of a lift when we got to 6 months. And I would say what's particularly interesting about that part of it is that I think what we're basically seeing is like you can keep a market price down through the dark pool, but eventually that market price is going to catch up. And for those that don't know, the dark pool is where institutions transact privately. And outside of market price, it's made for like larger orders. And just so people know, dark pools were created to actually create more transparency, because before they just transacted on their own, like pretty much just completely outside of the market. And also, just for edification, people do through swap agreements basically make their own derivative bets on these things, but at least we get visibility now into all of the stock transactions. So basically, you can use the dark pools to, move prices in different ways. Obviously, how we're talking about it is if you transact on the dark pool, you're not selling it on the market. So if you want to say cover a short, that's a really good way to maybe transact at a different price than the market would give you if you're buying in bulk, let's say. But transitioning to short pressure, actually what we saw was it was really reliable. That low short pressure in, especially the longer you went out, was a more reliable signal for a stock going up. And to me, that just very clearly means that like higher short pressure stocks, yes, in the short term, some of them could squeeze or get attention because of the high short pressure, but eventually that's going to happen and the short pressure is going to go down, the price is going to go down. And I think that's basically what's reflected in the numbers that we saw. So yeah, I think that's a really interesting divergence and a very important like education point that can't be stressed enough, that like, especially if you're like looking for a short squeeze, like you have to be very good with your exit or you're probably going to lose, even if you're right about the squeeze. And we've seen that so many times with retail investors, which is why I just don't think it's a very good way to invest, because you can look at like a short squeeze like a game of musical chairs, where some people are deciding when the music stops. That's the institutions. And retail investors, a bunch of them are just like kind of listening for if the music stops. And that's obviously a very different position to be in, and why I wouldn't recommend it. Whereas, it's interesting, dark pool, you can basically be like, okay, if I see this dark pool rating go like on a high level, I can see it pretty reliably go down. And actually, we dropped Tesla as a new thing looking at dark pool, and it looks like that was a very smart decision because it had a dark pool rating near 90, and we basically saw above 80 in dark pool as a short-term signal. Those stocks have performed very poorly like the last 3 months, inclusive of all of these other shorter term ranges. So yeah, I think that's super important. It's a great thing that you should look out for more now. I'm going to look out for it more now as an additional warning sign for longs, especially if you see both that short pressure and that dark pool rating elevated beyond 80. That seems to be a pretty reliable signal that, within 3 months, you're going to see those stocks, go down.
That's super fascinating. Definitely, I'm going to be looking out for that going forward. And we have a question, first question where I didn't have to beg for it. So that thank you to Chop Master. Uh, he's asking, did you dump the NVIDIA long? Can't find when it happened.
Yes, I think this is a really good thing for us to distinguish because it does confuse some people, and it's a good time to just really like talk about the differences here. And that is, we have a model portfolio for the trading letter, and that actually has had about 160 stocks over about 3 months churn through. Then we have the investing letter and the newsletter picks, and that has only had about 70 stocks in 9 months. So you're basically talking about 3 times the churn for the model portfolio. And basically what that comes out to is for the model portfolio, which is actually doing really well, considering that I think it's about 30% in excess of the S&P 500. It's going to be harder. Like part of what I'm doing with the newsletter is putting in deeper research. I'm doing higher conviction picks. And NVIDIA has actually never been a newsletter pick because it never really gets high enough upside breakout because it doesn't look like institutions are sure enough that it's going to go up long term, even in spite of its very high profitability plus growth. We actually saw, it's maintaining a 160, which over 6 months, we actually saw no stocks did. But stocks that like maintained over a 160 did very well on a 3 month time horizon. And profitability plus growth is a huge metric that we suspected, but has now been pretty well proven reliable in this market. So NVIDIA was never dropped because it was never added to the newsletter picks. It's still active in the model portfolio, and if you subscribe to the trading tips letter, you get access to the model portfolio. But those two things are very different because the newsletter picks are less stocks. It means that we're not going to necessarily have as much time to put the research in. We're going to be less picky about it. It's a larger portfolio. But the newsletter picks are going to be very high conviction, a lot of risk control. And that's why we're seeing, better performance there, obviously.
All right. So if you have any follow up, you can just feel free to comment and we'll get back to you, Chop Master. But that actually triggered a thought in my mind. I know there's like several different kind of weekly notifications that Prospero gives out. Like there's the Discord, there's the newsletter, there's model portfolio. Can you kind of just run through all of them for the people if they don't know which one they want to get? Or
Yeah, so the letters are going to be the primary ways to interact with Prospero in terms of just like what are the best ways to learn about what like our prescribed methodologies are. And the investing letter is going to be more about our safest picks. And that's like really designed to look at things on a 1 week time horizon, which is like different than some people approach investing, but we have kind of like a straight value section in the paid version later. And that's really just looking at things that we know are really solid risk controlled investments that might not have the same upside as some of the trading ones, but we're really doing a lot to limit the floor on those. The trading letter and the model portfolio, that sometimes we cycle out of things in a day. We're close to like frequent, like close to daily updates on that portfolio. So that's going to increase in more. Then the Discord, we're still experimenting. We're still building that out. That's much more freeform. That is like if you join it, and we can post the link again, that's much more just like whatever you want it to be. And then there's like kind of like a more graduate level of the Discord, which is where people actually help participate and update the model portfolio. And people on a volunteer basis, that will become paid eventually. So we're letting people that are helping basically volunteer get that for free in exchange for helping us, learn about the best way to do the portfolio. And the thing about the model portfolio and what I said, that is actually still a learning experience of what the best way to use the signals and not do as much research is. So I'm learning alongside like retail investors on that. The newsletter, for people that don't know the history, like those processes I've been working on for 3 years pretty much, and trading them on my own or investing them on my own before I even let retail investors use the app. And then a step further, they became organized enough when I even saw retail investors using the app that I could then write the newsletter and say, okay, these are the helpful ways to teach those processes. But we definitely want to get to a place, and that's why the Discord is really, like I say, it's much more of like a blank canvas, because we do think we're going to get to a place where we can have even higher hit rates on the model portfolio as well. It's just about figuring out the right mix of, research, action, everything alongside those. Like, the biggest thing that I've noticed in looking at the model portfolio is how difficult it is to both monitor and exit shorts without me watching them all the time. So that's something that we're really thinking about, especially the smaller cap ones, because there's been a few that I've just been really busy. I've been seeing them go up, and we took like 40-50% losses on them, and then they go down like below where we even entered, and kicking myself for getting out of them because the thesis was still like largely intact. But we're just trying to limit our losses because we don't want to take like a 400% loss on a short or something and just completely screw over the portfolio, which can easily happen. But yeah, that's the really tough part. But obviously the newsletter, why we emphasize it and why we emphasize the picks there, and why that's kind of like, the most important thing. Like, we have over 20,000 subscribers to that. That is where we've really honed that process the most, and where I'm most confident to say you can follow along with the newsletter picks or even some of them. And you're going to have a pretty good hit rate. Obviously we're at like 70% for all of them, which is absolutely amazing as a hit rate.
Yeah, so one of them is at like excess of 93% of the S&P, correct? Or am I wrong in that?
Yeah, that's the newsletter.
So is that the best performing one?
Yeah, I mean, there's only two.
Yes,
and that's the better performing one. Yeah.
Yeah. So people, if they want to go see that, how do they like sign up for the newsletter? Do they have to go on the Prospero website?
No, you just like Google like Prospero.ai Substack. Like, maybe if you just Google Prospero.ai, George Kalis, I think that's even in some of the top results. But yeah, it's over 9 months. That kind of performance is very significant, and it was something that we kind of like repeated from last year. So yeah, it's definitely worth following. We've done amazingly.
Mm-hmm. Yep. All right. So let's move on to some of the more direct stock related news stories we have to speak about today. First one is Joby Aviation, which is a very advanced new age company. They're an electric air taxi delivery company, I believe. I don't think they have any like current operations. They're still like manufacturing, testing, and honing in on what they're going to do. But they announced that they're building an Ohio manufacturing facility, and I wanted to get your input on Joby and how you feel about them.
Yeah, it's really interesting. I didn't even know they were in the app, but I checked them out this morning. And yeah, I would say that the very interesting thing about that is that, they do actually have higher upside breakout than downside breakout. They have very like pretty, I think it was like in the mid 70s net option sentiment. So yeah, it does look like the market likes them, and it does, like, especially like what I like to see, what I was talking about, like higher upside breakout than downside breakout is very important, especially for like a speculative stock like that. You wouldn't expect like an 80 upside breakout. That's for like ones that have like much less risk involved in them. So something like that, it's got an 82 growth. So something like that is a very interesting play, I would say, especially for the industry. I mean, obviously that's a very long, revenue path. But the nice thing about that is, like, for a company like that is such high upside, you don't necessarily need the actual revenue. You could have just like news that really pushes the stock up. So yeah, I think that part is just a really, like, it's definitely an interesting stock when I looked at it. And if you like kind of like high upside plays, it definitely does look like there is a good institutional energy behind it long term. That, like, and if you do see those kind of bets, that's a nice kind of added comfort beyond the high growth. But there is like 74 short pressure. So that is one thing that we saw, like higher short pressure stocks, don't tend to do as well. So if you're looking for a perfect, like a better entry, you might want to look at, like, I would say, like, upside breakout moving into the 60s and downside breakout, and short pressure also moving into the 60s. That might be something where I'd be more comfortable saying, like, I'd recommend this versus like if you have the right risk appetite, you can add it to your portfolio.
How do you actually feel about like the prospects of that business as a whole? Do you think like a company like Amazon, for example, could use Joby for delivering stuff, or do you think that's kind of like just a long shot type of business to be an air taxi company?
I don't like to bet on those kind of businesses that early stage. Um, but I would, as I was talking about, because I saw like the right institutional energy on it. Like as a business, I need to see things further along and actually understand like how they can win. Like, because the problem is like with a company like that, they could just be the trailblazers. Everybody could watch what they're doing. They could basically pay to make the mistakes. And then Amazon could just like essentially watch what they're doing, hire some of their people um, and build the same thing or build it better. So, like, and some trailblazers are amazing, but like, I don't need to necessarily, unless I see like better institutional things, which I would say, okay, if enough people believe on this, I could take this for a ride. Um, but for me, in terms of like investing as a business, it's like it's not proven out enough for me to say, and I think that that's the thing that some people just like they want like the 3,000% return, and that's great. I would rather buy options on a business that's further along to get my 3,000% return than buy an equity that I might be holding for 2 years and has downside risk pretty much to zero, and in the same way that an option might. Um, but obviously, the downside risk of a business going towards zero um, is something that like could happen on a news headline when you have a speculative thing like that. Whereas like an option when it's further along, there's I'd say less risk of that happening quickly, especially if it's a long expiration option. And the other thing about it is like as such like a business that like could take such a long time to develop, I don't necessarily want to wait a year or two when there's businesses today that I'm more confident will see that immediate, especially profitability growth because they have a 27 profitability rating and an 82 growth. If that profitability rating was higher, I would be more confident. But yeah, I'm honestly not even like I looked at it in Prospero. I'm not even sure where that. Well, I guess they're running losses. That's the thing. I was like, I'm not even sure where that profitability is coming from. I'm right. They're running at a loss. I'm sure. If they have that kind of rating. But yeah, I just like I would rather see something that has a better something closer to like at least like a mid 40s 50 um profitability and higher growth um just to like risk control a little better.
And the only reason I think we didn't even know that they were in Prospero is because they came public as a SPAC. So like they were kind of during that SPAC craze. So a lot of those companies went to zero, but here's one that maybe looks like it could be something one day. So we'll keep paying attention to Joby as they develop.
Yeah, those SPACs were crazy for a while.
Yeah, bull market, right? Okay, next topic. There is. It seems like there's a lot of strikes going on it nowadays with workers. Like we have the Hollywood strike, and now here's a union UAW, which that Union of American Auto Workers or something like that. They're striking, and it seems like it's actually affecting a lot of these legacy car companies. Um, and I wanted to see like, do you think this is actually going to have a lasting impact on some of the American car companies that are public?
Yeah, I mean, some of these businesses, it's just incredible. Basically how much they've like been embedded with these unions for so long, and like unions are a great thing for workers rights, but sometimes it can do things to make businesses non-viable, and maybe that's the business's fault, but I think that's some of what we're dealing with, like the pensions for auto workers in these very old companies are a huge part of the expenses that they're running, and that's a reason, like I think that's a reason that people are just like so much more bullish on something like Tesla. Like, cause like, yeah, there's like there's a lot of growth that they have to do, especially like on top line revenue, but the business, in terms of like, what you might call, like, it's used in programming all the time, like legacy costs. Tesla doesn't have like any of the same legacy costs as these like old auto manufacturers. So I think some of these strikes are auto manufacturers like understandably saying like, hey, if we're going to compete with a place like Tesla and like keep offering jobs, like we need to like help, we need help limiting some of these expenses or like to not meet all of your demands. And there's no right party in that, in my opinion, because like it's not the worker's job to make the business viable, but at the same time it is the business's job to be viable and compete. Or you might essentially see what's happening with a company like Tesla, where even though like as a business it has a lot to grow, like people are valuing it more than these auto companies that are like much more mature. And that's like something that's like, I would say, directly due to these legacy costs of these businesses and how substantial they are. So, we looked at some of them. Ford's in really bad shape in terms of the long-term options markets. GM's really interesting because nobody's really betting that much for or against it. And I think we just see those two things, like there's like a lot of legacy costs that are holding it back. But then you also see they're doing a lot more in, tech. They bought Cruise Automation. There is a lot of stuff that they're doing to modernize, but they might still have too much dead weight, and it looks like they do, for people to really be enthusiastic for them. I think they had like a 24 upside breakout and like a 36 downside breakout, and Ford had like a 15 upside breakout and a 68 downside breakout. So you could see right there that like people aren't as willing to bet against GM because they are making efforts to modernize. But at the same time, it's not nearly as bullish as Tesla, because Tesla just has like less dead weight and better modernization. So you can see right there why that would be the case.
2 follow-up questions to this segment. So if there was a Tesla news article that said like Tesla workers forming union, how do you think that would affect Tesla stock? And the day that this union strike against the legacy automakers gets resolved, do you think there's a tradable buy for those stocks?
Any news, like I think Tesla's so sensitive to news that anything that could even be perceived as negative is going to be something that hurts their stock. It's so news driven. So like I don't think unions would really hurt them that much, but I think it would hurt the stock in the short term. And the reason is it's like the legacy costs. Like even if Tesla does unionize, we're talking about what, like 80, 90 years before they've built up like some of these like pension costs existing. Like, there's a lot that it takes to get to the point where like, these automakers are essentially like carrying the dead weight that we're talking about. And, they could do it smarter too. And they're obviously heavy focused on automation. So I don't think it would be the same weight if their workers unionized, but I wouldn't bet on their workers unionized, as an aside. But then in terms of like the legacy automakers, like the strike isn't the problem, like for either side. Like it's going to be resolved something close to the middle. Like, there might be costs that continue to hurt the stock. But at the end of the day, the problem is the structure and all of this, kind of like the money that they owe, the structural problems that contains. And for that reason, yeah, it's like not, it's going to be tough for sure. Regardless, and it's like a structural problem to the business. So like news is not going to move it as much as a very news sensitive company like Tesla that has less structural long-term problems. So yeah, at the end of the day, like I think the automakers, like much like the same way as the studios, like there are structural problems in the business that they're trying to force on the workers, and that's not going to work. That's just going to create an antagonistic relationship. Like good management, instead of just trying to like grind the workers endlessly, like figures out new ways to structure the businesses. But these are clearly not well-run businesses. And that for the automakers goes way back, way further than the studios, that they've been run poorly. And that like, I think these businesses as constructed, especially in the auto industry, they're just not built to be hugely successful companies. That doesn't mean they're going to go out of business. They're just like not built anymore to have the potential of a Tesla. And I don't think there's any fixing that.
So do you think there's like opportunity for these young startup car companies like Lucid and Rivian Rivian to like, I don't know, kind of take their shot while these legacy automakers are in turmoil?
Absolutely. Like, and I think that's why like people, these, all of them, like, I think, some of them um trade like higher than they should, for sure. So yeah, I think that um that's going to be part of it and part of that speculation. But it's exactly what I'm saying. They trade higher because they have potential and they have less dead weight and they are focused on automation. And like a lot of these companies, like, not only that, like their models are like, Lucid's car is like beautiful, just like a Tesla. And like, yeah, like some of these car companies are modernizing, but like it is much easier to start a modern business than to modernize an old business, especially the ones with like significant legacy costs, like we're talking about. So yeah, I think that is like, I think that is a huge danger for these automakers, and I think GM is safer because they're using their connections and their clout to make waves in self-driving, and that's very, very smart. Um, but I would say that like, yeah, there's definitely a problem for the big automakers, but I don't think they're going anywhere. I think they like, if they die a death, it will be a very slow one. But all of these new ones, like especially if like, I don't know what the future of direct to consumer is, and if there'll be like a fight back that would obviously help the legacy automakers. But like some of these like legacy automakers, they just have like problems with like dealership structures and all. It's not just the workers; it's all of these people that they're like cutting into their process. That yeah, I think they're squeezing more and more, but like squeezing people that are part of your like sales and distribution um, is not necessarily the good way, like a way to have a good business either.
Yeah, so we have another question from Mr. Chop, and he's just asking how we can learn more about all the metrics and terminology and all of the things that go with investing. And is there any tutorials, or I guess you could suggest books and what he can read and learn more about investing?
Yeah, in every letter we send out, if you go down, there's like a, let's see, let me get exactly. There's like, it's like click our help, like newer to investing, looking for educational videos, confused by any terms, click our glossary help file, and you go in there and it's pretty well organized. There's a link to Prospero video resources, and that'll take you to like many different ways to learn about the ideas. um like if you go down that rabbit hole, you'll definitely learn a lot better, and it's really well organized. You can read about the signals, you can watch the signals, there's different ways to apply them. Like yeah, that's kind of like a pretty endless, and I'll just like I'll also post um I'll post it there as well. um that's a pretty much like endless like educational resource right there, and that's really what I would highly recommend um using. And there's tons, like especially the video resources we're always adding to. But um, if you see something in there that you like still doesn't make sense, we're happy to make videos too. If you want to be a little more specific, that's the broad version. But we will keep making videos on request, no problem.
Yeah, and I would just add that on this YouTube channel, actually, that the live is on right now, there's a video called Prospero.ai Signals Full Breakdown. And that has, if you're looking at the Prospero app, that's a good explanation of what's inside of that app. So I hope that helps you. Last stop we want to go in depth on today is Clorox announced that this quarter they had a pretty bad cyber attack, and it's actually going to lead to like a material impact on their earnings. And the stock is down, I think, like 2-3% today from it, which is it's the first time in my memory that I can remember a stock announcing that like a cyber attack is actually affecting their business. So do you think, like, what do you make of this? Is this going to happen more to companies as these cyber attackers become more advanced?
Absolutely, and that's why like people love cybersecurity businesses. And like I think something that we talked about with CYBR that ended up getting dropped um, is that a lot of people talk about like the open source movement, a lot about how it like builds software, but hackers also really benefit for that. And like on the dark web, and like a lot of these like programs that are built to hack, like people can get on the dark web. or even just like ways to Google it, and like that code is available. So like it's the same kind of thing as like any software development. These hackers are like standing on the shoulders of giants, and there's like hacker communities, and they work together, and yeah, like it's the same thing as any modernization. Like if you don't modernize, you face risks. And these hackers are going to get better. And if the businesses aren't getting better, if they're not paying for good modern cybersecurity, it absolutely will continue to happen. And I also just think that, like, we talked about this, like, it is going to be one of the main things, I think, for the world, like in terms of like military terrorism, everything like that. Like I always think it's funny that the US government like still is like buying like tanks and planes and stuff, especially when they're computerized. Because especially like, okay, like our biggest threat, China, like hacks into our systems all the time. Like, what does that mean? We're just building planes and tanks for them potentially if they know how to hack into our systems, like especially like the planes in their airspace. Like it's much easier to like hack into things when it's like local and you can actually like you know get some kind of signal pointed at them. So yeah, like to me, that is like a really funny development, and like yeah, it's actually one of the many frustrating things I've seen in Congress is I've actually seen like one of the I think it was like F-35s that a defense contractor wanted to build, and the military was just like straight up in its hearing like we don't want these planes. Like we would rather these resources go to other places, and the bill got passed anyway. So yes, I think like the world is not prepared for how much more important like cybersecurity is going to be and cyber defense than these like other forms that they're much more used to. And like yeah, any company that is not like that Clorox should be the wake up call, because the more valuable your data and company is, and Clorox is by no means like the biggest bounty, which is a really good example of it. Like if you are a more valuable company than that, like it needs to be that much more important. But like that's one of the reasons like AI also comes into play, because AI is very helpful in cyber defense. So like yes, a lot of these companies I would say that have really good AI have less risk um, of hacks. But yeah, it's really funny. I would always say that I didn't want LastPass because I was like, I don't want my passwords in there. I would prefer to keep them myself, because like too many people have LastPass, and like that is creating an attractive target in my mind, and they did end up getting hacked. And I think that that's just like one thing you always have to be mindful of, like the value of the situation and a budget the company has. And I really just think that's the problem. LastPass did not have enough money to like contain all of the valuable data that they had. And I think that that's just like, it's a rough equation. And I also think that that's like, when I hear like people like my parents being like, oh, like these hackers, they're like gonna get your stuff. I'm like, you don't have enough money for that. Like honestly, like they're worried about like it's directly proportional. Like yeah, like the richer you get, you absolutely need to have personal cybersecurity, because like the standard stuff just is not going to cover it. But yeah, it's just a question of like what's it worth, like because there are like also pretty serious penalties and pretty serious like institutions looking for you if you violate these laws. So that's the other part. Like, unless the bounty's big enough, it's not really worth it for hackers to go after, because the penalties are so severe, and like you'll have like FBI cyber crimes, or like potentially the NSA, or like some very serious technology efforts coming after you if you're like violating these laws. So, the reward better be pretty big. But yeah, that's just something that people have to like, every company needs to start thinking about, like, are we paying enough for cybersecurity relative to how valuable our data is? And Clorox was not.
Yeah, and actually, when I was reading more about this story today, they were saying that like a couple of the big like BetMGM and Caesars have experienced the same thing, but they just kind of pay the criminals so they stop the attack ends. So I don't know. It's an interesting thing for companies if they're actually going to like just pay to not be attacked anymore from these cyber attackers.
Well, like the ransom stuff is really difficult. Because you have these cyber attackers, and then it becomes a question of like, do you trust them enough that you'll pay them and they'll stop? Like, and for someone that you've met because they've hacked you, that's probably pretty difficult to wrap your head around. And I don't know if like, the extent that MGM like was able to like create a situation that they got comfortable with. I'd be very interested in the details of that. But yeah, it's kind of tough to say like, okay, like we're just gonna like hand over this money to you and then you'll stop like cyber terrorizing us, or like, how do you trust that?
Yeah, it's a deal with the devil. But something you said during your speech made me think of this story that I think you'll enjoy and our viewers will enjoy from my life the past weekend. So it was Saturday night. I was driving home. I'm like 2 minutes from my house. I see like 30 lights in the sky all together, like moving super slowly. I'm like, what is that? Is that a UFO? So I'm driving really slow. The guy behind me is like honking because there's literally like 30 lights in a straight line in the sky. I pull into a parking lot. I take a video. It's blurry. I send it to my whole family. I'm like, what the heck is this? Is this a UFO? I have two cousins that are Marines. So I was like, is this some kind of government thing? And no clarification. And then like 2 hours later, my cousin sends me this thing where it was a Starlink satellite launch that I guess they don't tell anybody about, but it's the way they were like in the atmosphere. You can see the line, but it's pretty crazy. And if you're interested, look up like Starlink satellite launch for the viewers. Like literally like 30 bright lights in the sky in a straight line, just like moving across the sky. It was pretty crazy. But something you
Yeah,
said just triggered that. I felt like people would be interested by that.
no, that's really cool. I will look for
um, yeah. So moving on, getting into our more macro portion of the episode, I wanted to ask you about Ray Dalio because he's been kind of like talking down the USA's future for a while now. And I don't know, it makes me feel kind of nervous. I don't know how you feel about it. He seems like a smart guy, he's very respected on Wall Street. So, you want to talk about Ray Dalio a bit?
Yeah, I mean, I'm a huge fan of Ray Dalio, and like if people haven't read his book Principles, it's like one of the best books um, I've read. Like, because it helps you like sort through like things in life, and it goes far beyond investing. And I do think a lot of how I teach investing is derivative of that, where it's like you have to get your philosophies and your approach right first. It's not about picking stocks. It's about figuring out like what the proper like approach and how you carry yourself around that approach. Um, and yeah, I'm pretty excited. I was actually like, I'm speaking at like the Finamize like Modern Investor Summit in December. And when I originally signed up, like a big draw was like, oh, I want to speak at the same thing as Ray Dalio. Like this is great, and he was the keynote speaker. And since then, I guess Jamie Dimon decided that he couldn't miss out speaking with me and Ray, but he's been added to the list as well. But yeah, I think that like he is just like Ray Dalio. Jamie Dimon is also pretty brilliant, and like he turned J.P. Morgan around. Like they were not even like they were one of the other banks when he started, and they're pretty much like number two to Goldman now in terms of like respect on Wall Street. So he's fantastic too. But Ray is like really like a lot of what the signals in Prospero were built on is kind of similar principles. Where, for those that don't know his story, he got started, one of his main things was in commodities, and like one of Bridgewater's big accounts, or I don't even know if it was called Bridgewater back then, was making McDonald's market neutral to cattle by hedging. So basically, like they would make a fixed amount of profits by hedging, in the cattle like commodities markets. And I think what's interesting about that, and like what my takeaway is like basically how he moved to stocks were just the same principles, if you will. He looks at a business, figures out some underlying equations that work for them, tests, and I always emphasize testing, using the scientific method. So experiments, hypothesis, experiment, result. Make sure that all adds up and is consistent, and don't make any assumptions. And that's how a lot of the formulas that are in Prospero were developed. They started as theories. I figured out ways to test them, and the team around me figured out ways to, test them. And then, they become metrics that also get tested on an ongoing basis. And we make sure if we want to alter them or change them or reevaluate them, we're not just like tugging at strings and seeing what works, but going back further, back to the original hypothesis, back to the original philosophy, and saying like, okay, what might have we been right or wrong about to start that we can then improve on, and how are we logically approaching that? And that's really how we got here with the signals, and a lot of it, I would say, might be inspired by Ray Dalio's approach.
Pretty cool. I can't wait to see you speaking with them. So when is that exactly?
Oh, it's just at the same time. I'm not gonna. They have their own speakers. They don't. They don't. They throw me in with them. But we're going to be on the same like undercard. I don't know what it's called as the same lineup. What is it called for a conference? I like maybe lineup. That sounds it sounds a little too music-y now.
We'll go with that.
Lineup. Yeah, sure.
So I meant to mention this, but we have a question. I forgot to bring it up before I asked you that. But is someone asking about Tesla is still shown as the top 5 in Prospero, but you're dropping them. So they're asking, why is that?
Yeah, I think it's still active in the trading model portfolio, and we talked about this a little earlier. It got dropped from the newsletter, and I think I explained this because it had pretty high dark pool and high short pressure. So that's something that we just saw in that newsletter is something that has been a pretty proven negative signal in the last 3 months or so. So yeah, I'm looking out for that a lot more, especially as I'm worried about the bear market coming back towards the end of the year and in full force. But yeah, I saw safer things, and I think today it was justified pretty quickly. If you look, I think I haven't checked since it started, but yeah, Google and Meta, the ones that I kept, are doing well, and Tesla not so much. So yeah, I think that's very important to keep in mind, and I'm going to be looking out for that. Even if the other signals look good, you might the best way to summarize it is yeah, there are things that look good for Tesla in net option sentiment, upside breakout, but on the other side, in terms of dark pool and short pressure, that's not signals that we viewed. So you might call it more muddled, even though it's got like very high net option sentiment on the extreme, but concerning parts on the other side. And some might be saying the mechanics of that, how could it work like that? Which is just net option sentiment is looking at everything up until 6 months of expirations. So it's very possible that both could be right. That people holding options to 6-month expirations or more towards the older ones are going to be right because Tesla's going to get hit and then it's going to go up after that. But these other concerning short-term signals like short pressure and dark pool means it's going to get hit a bit in the short term before it goes up again in the longer term. And that makes sense to me. I'll look to add Tesla again, especially if those numbers come down. But for now, it looks like it was the right decision to get rid of it because too much was stacking against it in terms of downward pressure as well in the short-term signals.
Yeah, so it's you're not saying Tesla is a bad investment overall. It's just in the short term, it may not be your favorite one. So,
and I think that's the difference in what the letters have been. It's a good investment, a bad trade right now is kind of, I think, how I look at that, why we even diverge the letters and why I'm still holding it today in the model portfolio, because it's a good investment and, in my opinion, a bad current trade.
Yep. Okay, perfect. There you go, Marcio. Marcio. Next thing, I saw something that the government could be going into a shutdown, and I was wondering how that will affect the stock market if that takes place.
I think that it's one of those. I mean, there's not going to be a shutdown. If there was a shutdown, it would have severe impacts on the stock market. But I think there's going to be some news events as it gets closer. The posturing, that's always going to hurt the stock market. That's just how the stock market reacts. And there's a practical reason for that. There is some risk the closer it gets to actually happening, that people have to hedge. They have to bake into their overall market view. So there's a very real and tangible impact to that. But I would say that the chances of it actually happening, like the both parties care too much about they like to posture, but I think they're both increasingly worried about too many people not liking them and getting fed up, even their own parties getting fed up with them, that that there's only a certain amount of risk they'll take in terms of being non-functional. So I think that's why we're not getting any stops. They both are starting to fear their own people, and they should, because overall they're both doing a terrible job. So that makes complete sense. So yeah, I think as it gets closer, we're definitely going to see impacts.
All right, question from Mario. He's asking if he should drop OTTR as a short because net options sentiment spiked over 50 currently.
Yeah, let's. I mean, I don't do it just on one pop because it might pop back below. But let's take a look. And I did say that you're correct. I was like, I don't want to invest above 50 anymore. But that's more of like a starting point and a 1 week hold. Yeah, that is that's definitely concerning. If it doesn't, I might look to drop it. I don't know if I'll drop it in the newsletter, because I tend to give those a longer chance to work itself out. But yeah, I might very well drop it this afternoon in the model portfolio if I don't see some recovery.
So how many readings above 50 would it take? Like a full day of readings like that?
Yeah, if it's not back below by the afternoon, or if I see it go above let's say 65, that might be a signal that it's time to get out. But yeah, I would say I do need to see some consistency, because you see spike ups and then back down all the time. But yeah, if it goes below 40, if it's back below 40 by the end of the day, I'll be patient in both the newsletter and the model portfolio. But I'll probably dump it this afternoon if I don't see that behavior.
So there you go, Mario. Hope that helps you. And we love questions. So if you're a viewer and you have a question, just feel free to comment. We'll be happy to answer.
Yeah, they're coming fast and furious today.
Yeah. Last thing I have is, I believe we have a Fed meeting this week, and what you expect out of that meeting. And also, I might add, I was watching some stock market program today, and they were saying that this week is the worst week of the year seasonally. So I just thought I'd add that in there.
Interesting. Yeah. Yeah, September is traditionally just not a very good month. I think sometimes the shorts are asleep at the wheel during the summer, and then they want to take control again. And it's what we're talking about. Shorting is more difficult, requires more effort. So it's not very fun to short on your vacation. So yeah, I think that that's definitely a concern. The way people are reacting to the Fed lately, or the way the market is just it doesn't seem to be making that big of an impact. Yeah, there'll be some volatility, but directionally, it's not necessarily what you'd expect, consistently. And sometimes it'll go up and down, or down and up. So that's one of the things that's making me emphasize the uncertainty that I feel right now. Because for me to feel more certainty, I have to be able to again, back to the scientific method, I have to be able to say oh, I expect the Fed to say something like this and the market to react something like this. That tells me I understand what's going on. If you can't even get if you get these fake outs we're seeing on the day, where it just basically looks like the market might even be testing itself, or kind of has no idea what it's doing, then yeah, it's hard for me to then be confident, because that's what I've been emphasizing lately. The market itself doesn't look confident in a direction. So how can I get confident if the signals are pretty scattered in terms of how the market is performing? And I think people should just be very careful and not get too bullish or bearish right now. And especially watch out for these fake outs, which obviously happen to a certain extent all the time, but they appear to be happening pretty consistently, where we'll see one strong direction and then it move in the other, and then maybe back in the other one. So I would say that's the big thing. don't make any big bets that day, regardless of like what behavior you start to see. That's what I would recommend.
That's a really interesting point that you're making, that like I feel like a lot of investors and just people even outside of the stock market, they don't want to ever say they don't know. They want to like pick a side. And it's okay to say like the market is wishy-washy. We're not exactly sure how it's going to react to a certain news thing. And that's just what it is right now. It's a time of like there's not a lot of clarity.
Yep, it's absolutely, and like I think that's like I forgot who I was talking to about this, but I would say like the method that I most subscribe to with investing is like the Socratic method, which is just like assuming that you don't know very much, or there's a lot that you don't know, and like to keep challenging yourself. And like, yeah, I think that like a lot of people, especially if they have a certain image of themselves as knowledgeable about the market, they like have to have a view and they have to be confident in it. And I think they're mimicking the confidence in other people, but like I know very few like great investors that have a view at all times. Like a lot of the best investors, like their standard approach is defensive, like very much hedged, very much like I'm taking this, like I'm leaning this way, but I'm hedging. And then like they make their big bets and their real money on the like small circumstances, or like, maybe it's like once a year, maybe it's not even that. And they say like, I have high conviction, I know what that feels like, and I'm going to make a big bet. And I think that that's something that like maybe people don't know because they just only see the clips and the evidence and the news articles about when those people are confident. So they think they have to be always confident. Um, but no, I would say a lot of people make their big wins either trading defensively, like buying options where they're pretty neutral and just like seeing when the market turns, um, or just like being honest with themselves enough to tell themselves when they're not sure that they actually know what it means to be sure. And you're never going to get there if you just assume whatever your best opinion at the time is you being confident. There's a big difference between those things.
Well said, sir. And that's just about it for today for us. We can stick around for a few questions, but I have another interesting Stephen story time. So
Go for it.
I know how you love Renaissance technologies like a lot. You respect what they do, and I thought it was interesting. I was reading an article over the weekend about how the CEO of them has spent over 2,000 nights spent at work over the past. I think it was like 10 years or 5 years. It was some. It was definitely 2,000 nights he slept at work, and I guess now we know why they are so good because he's absolutely dedicated to the business.
Yeah, and I mean, I think other than like the two co-founders, Robert Mercer and Jim Simons, um, the very intriguing part of their story that I would say even now is like Robert Mercer is like a big funder of like Cambridge Analytica, and like he's gotten very political and conservative, and Jim Simons is very liberal. But I actually think that's an interesting commentary on how important it is to have people around you that have different opinions if you want to be successful. And my understanding of the relationship from afar is that that's always been the case, but they've like, not only does that have them push each other on like, getting better, honing their process by just like having people that have like different viewpoints that you're used to having to like prove your points that much more. The other thing about it that's super important is that kind of like what we're saying. I'm sure in the cases that they do agree, that's that much more important to them and that much more of a signal that it's the right thing if you have people around you that that disagree with you. And it's actually funny, that conference, a little story about Prospero, that conference that we like that we're going to speak at with Finimize, like in the marketing package around it is like relatively expensive compared to like everything else that we spend on, especially for marketing, which is always pretty low, pretty organic focused. Um, but like one of my co-founders that's normally the person that says like is like challenging me on every dollar I want to spend, especially in that arena. He was just like, no, this is like the right conference, this is the right thing. So that made my decision very easy because I'm used to having someone that challenges me. And he just said, no, we should do this. And it was something I was laboring over and labored no further after that. So I think it's like I think that that's a really good thing. If you're thinking about starting a company, if you're thinking about like the types of opinions you seek out, I think it's so vital to find differing opinions. And one of the things that I think would really help the world a lot more right now is also respecting opinions that differ from yours, or at the very least, respecting the idea that someone can have different opinions and they still be good and they still comment about it the right way, and having people that you respect that have differing opinions from you is even more important, because you're more likely to take seriously what they say. But yeah, I think that that's just a vital importance. And like, certainly, I think if things are going to get any better in this country politically, it's got to start with like you listening, both sides listening to each other more, and like figuring out what we can agree on, instead of just like these like what seems to be seeking out fundamental differences that we then just like tell each other we're wrong about.
Get rid of the yes men, people. Get rid of the yes men. And with that, I think we are good for today, unless we have any last second comments. And I think we're ending up.
Nope, we will do the traditional, like, 1 or 2 minute where we leave people for it, but nope. I would say that that's probably it. Thanks everyone for joining. I think this was another week where we had a peak above 10 viewers, so we're building here. Thanks, guys.
We are, and thank you for watching the shorts. If you're people who watch the shorts, those are really starting to
Yeah.
pick up. So
Yeah, and hopefully
they all
the
come
ones
out
this
of
week
here.
will do better, where people don't think I'm in a bathroom. For the record, I was not in a bathroom last week. It was just a sink outside of the bathroom, and I was at the only desk in the room for those concerned. But back in my good environment. Hopefully we have the Zoom right, so we don't have blurry things, because I know we've been struggling with that on an ongoing basis.
Hey, it just shows the dedication you're willing to go to get the live stream up, which I appreciate, and I'm sure our viewers do too. But with that, I think I'll wrap it up.
I don't think the algorithms appreciated it, though.
No. We'll see everybody next week, Monday, 11 a.m., just like always. And until then, good luck with your investments. See you there.
All right, thanks. Bye.